December 23rd, 2025. Silver just did something that wasn't supposed to happen. It hit $72.71 per ounce, smashing through its previous all-time high and marking a 149% gain for the year. But here's what makes this absolutely insane. The banks tried to stop it. They activated their kill switch and it failed completely. Let me show you exactly what happened, because what we're witnessing right now isn't just a price rally. It's the breakdown of a 50-year system of control that kept silver prices suppressed for generations. On December 12th at 2 a.m. on a Friday morning, the CME board made a desperate move. They raised margin requirements on silver futures by 10%. This wasn't routine maintenance. This was a calculated attempt to trigger forced liquidations and crash the price. Here's how the margin hike kill switch is supposed to work. When exchanges raise margin requirements, traders who are leveraged suddenly need to put up more cash immediately. If they can't, their positions get automatically liquidated. Sell orders flood the market. The price crashes. It's been the COMEX's go-to weapon for decades to suppress precious metals whenever they start rising too fast. And it worked for about 5 minutes. 67 million ounces of paper silver got dumped onto the market in minutes. That's a massive forced sell-off under normal conditions. That kind of volume would absolutely obliterate the price. But this time, physical buyers absorbed every single ounce. The sell-off barely made a dent. Less than a week later, silver was at new highs above $66. Then it kept climbing. And on December 23rd, it hit $72.71, establishing a new all-time high that shattered the previous record from 1980. What just happened tells you everything about the state of the silver market right now. The demand for physical silver is stronger than the COMEX's ability to manipulate prices with paper contracts. Let that sink in. For the first time in 50 years, the kill switch didn't work. Let me give you some context. The COMEX was created in 1974, 3 years after Nixon took the United States off the gold standard. Without gold backing the dollar, the government needed a way to keep precious metals prices under control. If gold and silver prices exploded, it would expose the weakness of fiat currency. So they created the futures market, a paper casino where banks could short massive amounts of silver without actually owning the physical metal. For decades, this system worked perfectly. Whenever silver started rising too fast, the COMEX would raise margins, trigger automatic liquidations, and crush the rally. They did it in 1980 when silver hit $48. They did it in 2011 when silver approached $50. And they just tried it again on December 12th, 2025. But this time was different. Physical buyers stepped in and absorbed the entire forced sell-off. This tells us something critical. The paper market is losing its grip on price control because physical reality is diverging from paper promises. So what's driving this unprecedented demand? Industrial consumption is exploding. Silver isn't just a precious metal anymore. It's the most critical industrial commodity for the energy transition. Solar panels, electric vehicles, semiconductors, AI infrastructure, and solid-state batteries all require silver. And there's no good substitute. Silver has superior electrical conductivity compared to any other metal. A single solar panel requires about 20 grams of silver paste for the photovoltaic cells. Electric vehicles use significantly more silver than traditional cars. Data centers running AI infrastructure need massive amounts of silver for circuitry and cooling systems. This isn't speculative demand. This is structural industrial consumption that's not going away. Global silver demand has exceeded supply for 5 consecutive years. The Silver Institute projects a deficit of 95 to 120 million ounces in 2025. The cumulative deficit since 2021 is nearly 820 million ounces. That's more than 10 months of total global mine production, just gone from above ground stockpiles. Mine production is essentially stagnant at around 813 million ounces annually. Most silver isn't even mined for silver, it's a byproduct of copper, zinc, and gold extraction. You can't just ramp up silver production without expanding those other operations. Production is structurally inflexible and demand keeps accelerating. Central banks are now buying silver. This is massive. Russia, India, and Saudi Arabia have all started accumulating silver for their reserves. For decades, central banks only accumulated gold. Silver was ignored. But now, sovereign nations are treating silver as a monetary asset again. Russia has been buying for 18 consecutive months. Saudi Arabia just made its first ever silver purchase through the SLVETF. Why are central banks suddenly interested? Because they're diversifying away from the US dollar. They want hard assets that can't be printed, frozen, or sanctioned. Silver is cheaper than gold, more accessible, and it's in critically short supply. If you're a central bank looking to build reserves quickly, silver makes a lot of sense right now. The London bullion market experienced a full-blown shortage in late 2025. Silver lease rates, which normally hover near 0.25%, spiked to over 200% in October. When lease rates explode like that, it means there's virtually no physical metal available to borrow. The Swiss refiner Metalor announced they would not return to the London market until January 2026. Major banks withdrew from quoting prices. This isn't normal market behavior. This is panic. COMEX inventories have been draining at historic rates. Over 2 weeks in mid-December, inventories dropped by more than 20 million ounces. That's the largest decline in 25 years. Traders are airlifting silver from New York to London, trying to ease the squeeze. But logistics are complicated, costs are rising, and the physical shortage is intensifying. India's role cannot be overstated. In October, India imported 1,715 tons of silver. That's an absolutely staggering amount for a single month. An Indian investment banker posted on social media that silver was undervalued compared to gold. His message went viral right before Diwali, India's biggest festival. Traditionally, Indians buy gold for Diwali. But this year, they pivoted massively to silver. The result, silver premiums in India soared to over $5 per ounce. Multiple Indian silver ETFs had to suspend new subscriptions because they literally couldn't source enough physical metal to back the shares.